What is cryptocurrency and how does it work? Cryptocurrency is decentralized digital money that is based on blockchain technology and secured by cryptography. To understand cryptocurrency, one needs to first understand three terminologies: blockchain, decentralization, and cryptography. How does cryptocurrency work? In simple words, blockchain in the context of the cryptocurrency is a digital ledger whose access is distributed among authorized users. This ledger records transactions related to a range of assets like money, house, or even intellectual property. The access is shared between its users, and any information shared is transparent, immediate, and immutable. Immutable, anything that blockchain records is there for good, cannot be modified or tampered with, even by an administrator. Benefits of cryptocurrency. There is need for currency owner to trust single governing entity, as everyone in the network has access to the same information that cannot be altered. Data remains accessible only to the users of the network, and it is heavily secured. Shared ownership also means all users sign off on how accurate the data is, which means there is very little scope for data mismanagement or miscommunication. Think of it as a democracy. Security, which is fundamental part of blockchain. Cryptography is the method that secures data from unauthorized access by the use of encryption. Most of the claims that blockchain makes, like privacy and immutability, are inbuilt through cryptography. The roots of cryptocurrency technology can be tracked back to the 1980s with the invention of what is called a binding algorithm. Algorithm is all about secure and immutable digital transaction. It remains fundamental to the modern day digital currency. In the market today, Bitcoin. In 2009, Bitcoin was launched to the world, but it would be years before it was formally recognized as a means of payment among leading merchants, starting with WordPress in 2012. The underlying blockchain technology is today used in banking, insurance, and other business sectors, growing at a compounded annual growth rate of 12 into 8% since 2021. The cryptocurrency market is estimated to reach $4.94 billion by 2030, thanks to the need to improve the efficiency of today's payment system, rising global remittances, and increased need to secure data. How does cryptocurrency work? Cryptocurrencies are not controlled by the government or central regulatory authorities. As a concept, cryptocurrency works outside of the banking system using different brands or types of coins, Bitcoin being the major player. Number one, mining. Cryptocurrencies, these are completely digital, are generated through a process called mining. This is a complex process. Basically, miners are required to solve certain mathematical puzzles over specially equipped computer systems to be rewarded with bitcoins in exchange. In an ideal world, it would take a person just 10 minutes to mine one bitcoin, but in reality, the process takes an estimated 30 days. Number two, buying, selling, and storing. Users today can buy cryptocurrencies from central exchanges, brokers, and individual currencies owners, or sell it to them. Exchanges or platforms like Coinbase are the easiest ways to buy or sell cryptocurrencies. One bought currencies can be stored in digital wallets. Digital wallets can be what or cold. What means the wallet is connected to the internet, which makes it easy to transact but vulnerable to thefts and frauds. Cold storage, on the other hand, is safer but makes it harder to transact. Number three, transacting or investing. Cryptocurrencies like bitcoins can be easily transferred from one digital wallet to another using only a smartphone. Once you own them, your choices are two: A. Use them to buy goods or services. B. Trade in them. C. exchange them for cash. If you are using Bitcoin for purchases, the easiest way to do that is through debit card type transactions. You can also use these debit cards to withdraw cash just like in an ATM. Converting cryptocurrency to cash is also possible using banking accounts or peer-to-peer transactions. Type of cryptocurrencies. There are tens of thousands of cryptocurrencies available today, with the figure pegged at 10,000 in 2022. Major cryptocurrencies included the following. Bitcoin. Bitcoin is the world's first widely accepted from the cryptocurrency. Bitcoin is so popular, there was a time when its name was synonymous with cryptocurrency. But potential investors need to know Bitcoins have become very expensive. In 2021, the cost of one Bitcoin was $68,000. But the good news is you don't always have to buy an entire coin. You can easily use for any alternative digital currency to Bitcoin. The most popular in this ecosystem is Ethereum, one of the fastest growing cryptocurrencies in the market. There is also a range of other altcoins in the market today, such as Lucky Blocks, Shiba Inu, and Terra. Crypto tokens. The concept of crypto coins versus tokens can be confusing to many. At first glance, coins and tokens appear the same. However, the two have many differences. Coin can be mined, but token cannot be mined. Coins are linked to the blockchains. Tokens are not. In terms of utility, they vary in the type of. Should you invest in cryptocurrency? There are many advantages to dealing in cryptocurrencies and a fair share of disadvantages as well. Here are the top 3 reasons that work in favor of and against cryptocurrencies. Advantages. They are private and secure. The blockchain technology that fuels cryptocurrencies ensures users' anonymity. It also assures high levels of security through cryptography, which we discussed before. They are decentralized, immutable, and transparent. The entire system functions on shared ownership where data is available to all. They are private and secure. The blockchain technology that fuels cryptocurrencies ensures users' anonymity. It also assures high level of security through cryptography, which is discussed before. Our permissions are decentralized, immutable, and transparent. They are decentralized, immutable, and transparent. The entire system functions on shared ownership where data is available to all. They are private and secure. The blockchain technology that fuels cryptocurrencies ensures use anonymity. It also assures high levels of security through cryptography, which is discussed before. Permission, member, and is tamper-proof. They are a hedge against inflation. Cryptocurrency makes for a great investment in times of inflation. For example, investors often compare cryptocurrency to gold. One of the reasons behind this is that, just like gold, they are in limited supply, as there is a cap in mining any type of cryptocurrency. They are not widely understood. They are relatively new concept, and the long-term sustainability of cryptocurrencies remains to be seen. They are prone to high risk. Needless to say, cryptocurrencies bring in as many rewards as risks. Their highly volatile and speculative nature makes them prone to sharp downward spirals. Investing in cryptocurrency can be risky for many reasons. A major deterrent could be the fact that digital currency seems to have no inherent or underlying value. There is a supply-demand type of equation that is used to be determine the value of cryptos like bitcoins. It is easy to see how simple speculation over the internet can result substantial rise or lose of value of these coins. Also, the fact that cryptocurrencies are banned or their use is restricted in a lot of countries out as a significant legality is debatable in countries like India. Scalability is a problem. This is a complex issue which has more to do with the technology side of the blockchain. Simply put, the sluggish nature of the blockchains make it prone to transactional delays. This has the tendency to make crypto payments inefficient when compared to modern day electronic payment techniques. What is the future of cryptocurrency? Cryptocurrency has come a long way over the last decade, advancing at a light-speed pace. Value can be stored, transferred, and spent in different ways through various assets and solutions, while DeFi has pioneered the way for new borrowing and lending avenues. Some mainstream also view blockchain technology itself with interest, evaluating various uses such as supply chain. The future of cryptocurrency and its associated technology appears bright, judging by the growth and adoption that has been seen since 2008, when Nakamoto published the framework for a little asset called Bitcoin. Whether cryptocurrency is the future of money or not, one thing is clear: it is not advisable for anyone to invest in it without doing enough research. Investing in cryptocurrencies is not a new phenomenon, but with a recent surge in popularity and value, coupled with the falling returns to bank deposits, more people are looking for cryptocurrency advice. If you have decided to invest in cryptocurrencies, ensure that you start with the leading cryptocurrencies like Bitcoins, as newer ones may not have sufficient liquidity. You may not be able to sell them when you want to. The market is rife with scamsters, hence using authorized platforms to buy or trade crypto is important, especially while starting out. Investing in cryptocurrency is a risky venture. You need to be aware that there is a high chance of losing your money. If you are not comfortable with the risk, it's better to stay away from it. There are many ways you can profit from cryptocurrency: buying coins, trading coins, mining coins, and so on. The last one requires the maximum resources but also has the potential for higher returns, while buying or trading can be done. Cryptocurrencies are also highly volatile, so it's recommended to start small and diversify your investments. Simply put, do not place all your eggs in one basket. As a beginner, it helps if you initially rely on expert advice and gradually grow your own expertise by researching the subject. For this type of research to be successful, it is also important to develop an understanding of your country's historic and current policies on cryptocurrency. And as always, don't invest more than you can afford to lose.